Good day, everyone. Today, I'm as a team leader of the group 5, going to speak about mutual hedge funds, hedge and mutual funds. Yeah, about the difference, about investment types, and etc. So, table of content. What will today cover? We'll cover about mutual funds, about hedge funds, difference between mutual and the hedge funds, and the last part will be about summary. Yes, some will summer today's our video. So that's why keep watching, keep listening. It will be very interesting. So mutual funds. Today we'll start with mutual funds. Yeah, about mutual funds. And a mutual investment fund is a financial company that raises money and invests in it in various financial instruments. Yeah, types of mutual funds will cover advantages of mutual funds and disadvantages of mutual funds. Yeah, mutual funds pull money from the investing public and use the money to buy other securities, usually stocks, bonds. The value of the mutual funds company depends on the performance of the securities it decides to buy. Yeah. So how mutual funds work? A mutual fund is both an investment and an actual company. This dual nature may seem strange, but it's no different from how shares of Apple. Yeah. When an investor buys Apple stock, he's buying partial ownership of the company and its assets. Similarly, mutual fund investor is buying partial ownership of the mutual company and its assets. The difference is that Apple is the business of making innovative devices, and in the mutual funds, while mutual funds company is the business of making in return from a mutual fund in 3 ways. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of distribution. Funds often give investors a choice either to receive check distribution or to reinvest their earnings and get more shares. The second is that if the fund sells securities that have increased in price, the fund has capital gain. Most funds also pass the 3 gains to investors in a distribution. If fund holdings increase in the price but are not held by the fund manager, the fund's shares increase in price. You can sell your mutual fund shares for profit in the market. Yeah, in the market. To summary, it's a mutual funds is a type of financial company. Yeah, it's a financial company when you are investor, yeah, or you are a businessman, and you have a money, yeah, you have money and you want to invest. However, you don't know which company to choose in order to invest. In that case, you give money to mutual funds, and mutual funds invest your money to you buy. You don't give money to mutual funds. You buy their shares, yeah, shares, and into your money mutual funds do buys stocks, bonds, and etc. And in that case, if the price of stocks, bonds rises, you earn. Yes, so mutual funds are investment tools which are more straight to the kind of mutual funds. I think from point of my view, it's like kind of investment funds which are not very risky and very which are not gives a lot of money in 1 year. Yeah, if you, for example, invest $1 million, you can earn 1,100,000. Yeah, in 1 year it's not much money, but I think the mutual investment funds are more to people who have a lot of money, yeah, which they have earned not in an investment, which they have earned in their business, and they want to save the money, from the inflation. Yes, if the inflation in America, for example, 3-4%, they want to earn in a year more than 3-4%. Yeah, I think it's like on the investment funds. So there's types of mutual funds. Open-end mutual funds. Yeah, investment in mutual funds have grown from 5 billion, yeah, 0.5 billion in 1942, over 10 trillion in 2008. Most common type of is open-ended. This means that number of shares in the fund goes up in investors buy more shares and down as they redeem shares. All purchases and sales shares are not at PM net asset value of the fund. So here's some information from Business Insider, number of mutual funds and the revenue. Yes, it's in USA. It's more than $20 trillion, the revenue. Yeah. Closed-end mutual funds consist of fixed number of shares that are traded in the same way as the shares of the other company. The share price tends to be less than the NAV. The hedge fund industry today. Hedge fund industry has made comeback since then. Total asset under management grew about from 2.3 trillion in 2002 to about 3.6 trillion in 2019. Yeah. Hedge funds exclude small investors. Hedge funds can accept money only from qualified investors, individuals with an annual income that exceeds $2,000 for the past 2 years, or net worth of exceeding 1 million, excluding their primary residence. Some set their minimums higher. Yeah. It's these prices, I mean, these minimums in USA. Yes, hedge funds. To summary about hedge funds are the type of funds where these fund companies invest not only in bonds or stocks. They invest in more risky in shares. They buy more risky shares, more risky stocks, in order to earn not 3 or 5% a year. They in order to earn more percent. Yeah, if you bet on risky stocks, you will or lose, or you will earn much more money. Yeah, that's why they invest in like type of stocks, and it's much more riskier than mutual funds. Yeah, if your net worth is more than 1 million, you can give some money, and you are agreed that you can, if you will lose this money, you will be okay. Yes, that's why they only get money from people who earns more than 22,200 for the 2 years. Yeah, and who has the net worth more than $1 million. Yeah. So hedge funds are not regulated by any commissions. They use risky strategies in risky ways. Hedge funds can earn returns using a variety of tactics. Hedge funds are designed to take advantage of specific market opportunities. Yeah, hedge fund is a form of alternative investment that pools capital from individual or institutional investors to invest in varied assets, often relying on complex techniques to build its portfolio and manage risk. Hedge funds can invest in anything from real estate to currencies and other alternative assets. This is one of many ways in which hedge funds differ from mutual funds, which normally only invest in stocks or bonds. Yeah. Investment strategies of hedge funds. Hedge funds are generally seen as aggressive and risky. particularly when compared to mutual funds. This is down to where they invest. While every hedge fund will have its own specific investment strategy, the idea that hedge funds derives from the agency to define manager, to implement certain trading tactics such as shorting stocks if they anticipate to drop in the market, or hedging themselves by doing long if they foresee the market rise. So I have spoke about the mutual funds, about the hedge funds, and now I will speak about the difference between mutual funds and hedge funds. So mutual funds are regulated investment products offered to the public and available for daily trading. Hedge funds are private investments that are only available to accredited investors. So the second one, hedge funds are known for using higher risky investment strategies with the goal of achieving higher returns for their investors. At the same time, mutual funds are not risky. They don't use risky strategies. They use the strategies that from that you can save your money and increase your money to 5-10% in a year. So difference. Mutual funds are commonly known in the investment industry. The first mutual fund was created in the passive funds give investors the opportunity to invest in an index for targeted market exposure at a low cost. Closed-end funds offer fixed number of shares in initial public trading, the IPO. So hedge funds have the same basic pooled fund structure as the mutual funds. Hedge funds are often more risky than mutual funds. Hedge funds, on the other hand, have higher management costs than mutual funds. So according to the investment news, as of March 23, largest mutual funds asset managers included. Also the one of the difference is that as I have told, mutual funds are offered from the public and available for daily trading and and also they are regulated mutual funds are the funds that are regulated in the other way. Hedge funds are not regulated by the SEC, by the SEC. They are not regulated, Also, in the hedge funds, in the mutual funds, you get fees 1 to 3%. On the other hand, in the hedge funds, they get fees for doing your money, more than 1-3%. So also in hedge funds, the managers analysis which invest in stocks, in cryptocurrency, etc., they also invest their own money, in order to feel real, in order to feel real that it's money. In the mutual funds, it doesn't matter, they will invest or not. On the other side, in hedge funds, managers should invest their own money to this bet that they have invested others' money. It's the very one of the difference also. So both mutual funds and hedge funds are managed portfolios built from pooled funds with a goal of achieving returns through the diversification. This pooling of funds means that manager or group of managers use investment capital from multiple investors to invest in securities that fit a specific strategy. Mutual funds are offered by institutional fund managers with a variety of options for retail or institutional investors. Hedge funds target high net worth investors. These funds require not investor meet specific accredited characteristics. So I think for today it's all. Thank you for your attention. I think you have enjoyed with that video, with that presentation. So the presentation, the video, the awards which are made by Mandar, Zizbek, and Rahim John. Thank you for your attention and goodbye.